Welcome to GRE. I'm your host, Keith Weinhold, a discussion about the future mortgage rate direction. Then there's a property loan type where you don't have to make any monthly payments. And if you do make a payment, it all goes toward principal and nothing is lost to interest. It can save you lots in interest expense over the life of the loan. Today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Clackamas County, Oregon to Lackawanna County, Pennsylvania, and across 188 nations worldwide. I'm Keith Weinhold, and you are back in for another wealth-building week here at Get Rich Education. Just another shaved mammal with the microphone here. I have a real estate analogy for you. Growing up, my dad told me, whatever you do, do it well. And that was broad guidance for life. I like things that are easy to remember. Our simple home in Appalachian, Pennsylvania was heated with a wood-fired stove, so we couldn't just turn a dial, and feeding the stove with those logs took time and work. It was a family effort. Dad split the firewood. My chore was to regularly move firewood from the wood pile into the home. And then mom or dad would start the fire and constantly tend to it and get it up to the right temperature. But when that fire finally roared, it felt like it could have heated 5 homes. And this is like buying an income-producing rental property. You can't just point and click to make income reliably appear. It takes time and even some of this admin type of work before you feel hot returns. The spark that can ignite the fire means first putting your financial house in order. Those are things like getting pre-approved for a mortgage loan. And then there's stacking the firewood, which means finding a deal, making an offer, booking a property inspection, scheduling an appraisal, perhaps signing a property management agreement if you're not self-managing, and then, of course, placing a tenant. But see, when that investment property fire roars after a year or two, that can create enough returns for 5 retail investors, just like our roaring wood fire could have heated 5 homes, even though you're only one investor getting like 5x returns. And by now you probably felt, after a year or two of owning it, the profitable warmth of the 5 ways you're paid that you know so well. Those 5 ways are leverage appreciation, cash flow, tenant-made principal paydown, a tax benefit basket, and the quiet, whispering fire of inflation profiting on your loan. But you can't get over-leveraged, meaning that you can't make the payments, or else you'll burn the whole house down. This means embracing the right level of debt rather than avoiding debt altogether. So, yeah, if you want to be in the top 1% or maybe even top 5%, do you know what that means? It means being misunderstood by the masses. And when you do this right, it's not about getting rich quick, but it's about building wealth for sure. Feel the fire, and whatever you do it well, just like my dad told me. And oh, by the way, today my parents still live in that same house, but they now just turn a dial for heat. Well, there's been a lot of real estate and financial news lately, just this constant feed of news. And I really need to tell you something about that. I am not a news reporter. If some news just broke an hour ago, a lot of times people are only overreacting to something like that. So here at GRE, I infuse the news longer term into our content of the show because some of it is just too big to ignore, but often let it settle down for a little while and filter out what it really means to you as an investor. I mean, being an educational platform rather than a news platform is what it's about. So I want to make sure you understand the relationships rather than just reporting the news. I mean, for example, what tariffs can do to home prices and rents and inflation. I mean, that really impacts you and your real estate long term, rather than just doing something like reporting that the tariff on this nation that looked like it was going to be 25% is now only going to be 10% or something like that. That really doesn't affect you so much. So now that you know more about what to expect here, which are the stories that really affect you as an investor, the last inflation report did come in at a hot 3%. That startled economists that it was that high. And what that does is that makes bond yields rise because bond investors need a real return net of inflation. And in turn, that soon makes mortgage rates rise. And also, it makes Jerome Powell be in no rush to cut his Fed funds rate after this hot inflation report either. And here's another long-term relationship that can help you learn. The Fed's dual mandate is what? Do you know what it is, the two things? I've mentioned it to you before. The Fed's dual mandate is maximum employment and stable prices. That right there is inherently volatile because when employment is maximized, well, then employers, they have to compete with higher wages in order to attract workers, and that makes prices go up, destabilizing the prices. Well, stable prices is the second part of the dual mandate. So that's why it always seems like there's this lightning rod attention on Jay Powell in the Fed. It is because the dual mandate is inherently volatile. Now, you know what I think about predicting mortgage rates. I don't like to do it because it's an almost impossible task, like the myth of Sisyphus, that Greek myth about rolling a boulder up a hill. Wells Fargo says mortgage rates will go down to just 6.5% by the end of this year, so not much of a drop. And also, by the end of next year, almost 2 years from now, they'll still be just 6.5%, and others see rates rising from here. So there is broad consensus that there's zero reason to think that artificially low rates are going to return anytime in the near term, perhaps even in the intermediate term. Coming up on a future episode of the show here and soon, how to use AI in real estate investing. Today, let's talk about mortgages and a special loan type. Today, we are back with the national leader in providing Americans with income property loans. She runs the operation at Ridge Lending Group. She's been doing this 25 years. She's an investor herself. It is their CEO and president, Caeli Ridge.
Keith, thank you for having me.
There does seem to be one U.S. president that makes a lot of news lately, but Caeli is still the most noteworthy mortgage type of president, I suppose. And just like GRE, Ridge focuses on education, and Caeli, mortgage rates. It's the topic that everyone wants to talk about. I don't predict mortgage rates, but I know that you'll talk that talk a little. And previously, many expected Jerome Powell and the Fed to drop their rate 4 times this year, then 2, and now more and more expect 0 rate cuts at all this year, even opening the door for rate increases if inflation persists. So tell us about the propensities of this year's mortgage rate direction.
I think that I agree with a lot of the volume out there related to interest rates kind of staying the course. I don't think we're going to see too much of a decline. There's certainly, Keith, we talk about this ad nauseum. There's all kinds of things that could derail that statement that we can't prepare for, we couldn't predict for. But I think overall rates are going to stay steady. I think that whether you like them or you don't like them, the tariffs tend to come with an inflationary tone. And if that's the case, it's going to put Jerome and his buddies at the Fed in a tough position to do what they had hoped to do with the monetary easing. So I don't expect to see it, but I'm hopeful. Who knows? Who knows?
Now, for you, the listener and viewer here, when you really want to know what moves rates around, Caeli, talk to us about this persistently high spread. And what that means is that historic difference between mortgage rates and the yield on the 10-year Treasury note.
I feel like a lot of what that's going to attach itself to is the inflation. And then more specifically, when we talk about LLPAs, and I think we've talked about this in the past, loan level price adjustments, mortgage-backed securities, secondary market, right? This is an investment that is bought and sold on the New York Stock Exchange, right? These are investments that carry value. And while the Treasury is usually the one that people will look at to predict where interest rates are going to go, I feel like in this higher rate environment, the secondary market understands that these mortgage-backed securities are going to be paying off in advance of profitability. Now, this gets a little bit complicated, but the easy way to explain it is that if you secure a loan today at, say, 7.5%, if the anticipation is that interest rates over the next 3 years, maybe not in the next year, but 2 years, even 3 years, are going to decline, the mortgage that was closed today will likely pay off via a refinance. In that event, it's not reached the maturity date such that when that initial mortgage-backed security was purchased on the secondary market, it will have to pay off before the investor has been made whole or profitable. As a result, the margins, in my world, it's called YSP, yield spread premium, will not be met. So they're baking in certain levers, or they're hedging, as another way to say it, so that they're not left with those negative balances when these things do pay off, when interest rates come down, because interest rates are not a straight line. They go up, they go down, they go east, they go west. So as a result, they're planning far in advance into the future. So I think that has a lot to do with it.
Real estate industries are shrinking, and it's all related to the fact that back in 2021, the number of existing homes sold peaked at almost 7 million, but last year it was only about 4 million. That is a huge drawdown. The number of U.S. realtors is dropping since it peaked in 2023. And Caeli, from what I can see, the number of loan officers even operating has dropped precipitously over the last 4 years. It's a reminder that the strong survive. And in the mortgage industry, top service is what savvy borrowers need. You go with the people that consistently advise you to take your time and look at your long-term strategy and make the correct decision, not always the one giving like 1/8% lower and an interest rate. So any lender can get you the next loan, and few are going to help you with your long-term strategy. With this overall lower volume of transactions taking place, what are your thoughts about how it's impacted the mortgage and lending industries?
It's such a good question. I'm glad that you asked it. And I really do think it speaks to the experts in the space.
Yeah.
Consumers, our borrowers, as we call them, have to be, I believe, a little bit more discerning about who they want to align themselves with and who they want to work with. As it relates to the interest rate, we've had this conversation off book. Ridge doesn't sell rate or cost. Now, we're competitive, but we're never going to be the lowest possible lender out there. There's always going to be somebody that can undercut for 1/8, like you said, a quarter point, a few $100 here and there. And we just don't get into that. Our value adds far exceed 1/8 of a point in rate, which, by the way, you probably can predict what I'm going to say next. If you're not doing the math, just as a sidebar, listener, the difference in payment, and that's really where the focus should be, the difference in payment on 1/8 or a $0.25% in interest rate on $100,000 is all of $5, $7, $8 a month.
Yeah.
Okay, so make sure you're doing the math. But the value adds that come with the education that we provide, the 49 states, large footprint, and the diversity of loan product, I think far outweigh any eighth or few $100 difference when you're comparing side by side. I'm not saying that you don't want to get comparisons and you don't want to be a smart, informed consumer, but it really does matter that your lender understands known owner occupied, understands how to take you from point A to point Z today and 5 and 10 years down the road.
You've been a mortgage industry leader for a long time. With this lower volume, have you seen mortgage companies implode, close shop?
Absolutely. We have access to those data points, and the number of loan officers, just the individual in the doing the transaction, not including processors and underwriters and funders and doctorars, but just the loan officers, I believe in 2024, reduced by a margin of 53%.
Gosh.
Yeah, that's a big number.
Yes, this has really hit the industry substantially. Are there any other interesting industry trends in this environment where we have persistently higher rates? I make sure not to say high because historically, mortgage rates are still not high, the long-term average being 7.75% on the 30-year fixed rate mortgage. Are there any other trends that this loss in activity has created?
I feel like the informed investor is still finding ways to profit in real estate. They're finding diversity is key, which I'm a big proponent of, as are you. That means single-family residence to 2 to 4 units, cash flow versus appreciation, the short-term rental, the long-term rental, the mid-term rental. Making sure that they have a good rounded portfolio is key. And there are some, which I think we're going to be talking about today, there are some mortgage tools that I really feel like for an informed investor are allowing them to continue and propel further, even scale into the 25 and 26 years.
What's happened to the volume of owner-occupied transactions versus investor transactions? I would imagine that investor mortgage transactions really aren't down that much.
Not that much. I'd say there was a small blip, but I feel like we've made those up with some of the Burr strategy loans. We do, of course, all kinds of mortgage-related transactions specifically for investors, and one of those products is a short-term bridge loan, which would apply to the Burr method: buy, rehab, rent, and refinance. So we've been seeing quite a bit of that, where the investor will find a good deal on market or off market where they can put a little bit of lipstick on it and then refinance it at the ARV or after repair value. So anything that we might have lost in just the traditional 30-year fixed straight purchase transactions, I feel like we made up in the other, but it wasn't a big margin.
What if there was a mortgage product out there that just didn't work like other mortgage loan products do? For example, your deposits or the payments that you make on this special type of mortgage is applied to the principal first and only. And there are a lot of other interesting characteristics about this particular mortgage product. We're going to discuss that when we come back. You're listening to Get Rich Education. We've got the CEO and president of Ridge Lending Group back with us, an investor-centric lender. I'm your host, Keith Weinhold. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K, and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866. Hey, you can get your mortgage loans at the same place where I get mine, at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Caeli Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Rick Sharga, a housing market intelligence analyst. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with a steady guest over time because not only are they an income property-centric mortgage loan company that do mortgage loans in 49 of the 50 states, but they're also centered on education and looking out for you, the investor, over the long term. And Caeli, such an interesting product that you offer is called the all-in-one loan. It's been a long time since you and I have really talked about this. What it is a first lien HELOC. It's a way for you to use the equity in your existing properties. You can do it with either a primary residence or investment properties. There are just so many reasons why an all-in-one loan just kicks the butt on a conventionally amortizing loan, including that all payments are applied to principal first and only, and a lot of other exciting things. So, Caeli, why don't we back up and just describe what the all-in-one loan is, big picture?
Now, there is a lot to unpack, so we're going to take our time, listener. First of all, let me just explain, why is it called the all-in-one? It's called that because it doubles as both a mortgage in the form of an open-ended revolving HELOC and checking and savings. Both of those two features are combined, hence the all-in-one, as a way of diminishing the amount of interest that can accrue over time. Let me explain. So any revolving account, any account, including a credit card, for example, but first lien HELOC, second lien HELOC, whichever, doesn't matter. Open-ended revolving is the key. Any open-ended revolving account will accrue interest daily based on two factors. The first being that day's balance and that month's, in this case, interest rate, fully indexed interest rate. I'll come to interest rate later. As a result, you now have control largely over how much interest can accrue. Now let's take that statement and transfer it and look at it against an amortized closed-ended mortgage. You sign up for a 30-year fixed mortgage today, let's say it's 7%, whatever the interest rate is really irrelevant. Your principal and interest payment are defined on day one. There is no changing that monthly payment. Right. Now, you could certainly accelerate the payoff of that mortgage debt by doing what? Applying additional
extra principal payments.
Right. But what happens to that extra principal payment when you send it off with your 30-year fixed mortgage payment?
It drops your loan balance, but your minimum payment amount is the exact same the next month.
Right. And then what happens to all that liquidity that you had prior? It's now illiquid, right?
Exactly.
Sent that off.
You've just transferred your cash flow into equity. Financial freedom is created by doing the opposite thing and changing equity into cash flow.
Very illiquid, and not the way an investor typically is going to want to run his or her business. So hence the all-in-one. Now, for those of you that have heard the term velocity banking or infinity banking, maybe whole life insurance policy has a similar tone to this. The all-in-one, I believe, offers even more flexibility for a variety of reasons that we're going to get into. But if you've ever heard those terms, that's similar to what this is. So I want to start by, I usually like to give an example, okay, and provide some visual aids so that people can connect the dots. Let's start with the 30-year or a fixed rate mortgage, just because I feel like, especially in the US, this particular loan product or its concept is widely used in much of the rest of the world. In the US, I feel like we're sort of preconditioned here to really only understand that closed-ended amortized mortgage. So I'm going to start with an example there that actually highlights or leads into the concept of the all-in-one. So I want you to imagine a 30-year fixed mortgage and a 15-year fixed mortgage. Both of these mortgages originated or started at $400,000 as the balance on day one. The 30-year fixed mortgage locked at an interest rate of 4%, and the 15-year fixed mortgage locked at an interest rate of 7%. Now, when I go through this exercise and I give this example to people, I ask them the question, well, which one would you choose? And without exception, if they don't understand amortization, they are going to select that 4% 30-year fixed mortgage because they don't understand that it's about speed. When you run the math and you look at an actual amortization table, you'll see that you'll pay $40,000 more in interest on a 4% 30-year or 360 month versus a 7% 15-year or 180 month. So the point here and what I'm illustrating is it's speed. Now let's segue back over to the all-in-one. It's all about speed and how much interest we allow to accrue over time. So as you had mentioned to kick this off, Keith, every deposit acts like a payment. Now here's where I struggled with this in learning. And when this was first introduced to me years ago, this part of it really caught me off guard. I had to really dig in and try to focus on what are they talking about? What do they mean? There's no payment due on the all-in-one. I'm going to say that again. There's no payment due on the all-in-one. Think about your 30-year fixed mortgage. If you don't make a payment, what happens?
You're defaulting. You're in trouble. You become delinquent.
Right. So that is not how this loan is set up. And it's not smoke and mirrors, okay? It's nothing fancy. The deposits that you make from ordinary income, from all sources, really, okay? So we want to talk about, this is really special for investors because we have access to gross rents, the rental income that's coming in before we send it back out the door, along with our net wages and every other source of income deposits that we're getting, can be utilized to your advantage. One of the ways in which I describe this is I like to say you've become your own bank. So you have this line of credit, and your gross rents and all of your net wages are going to deposit into your checking account, driving that principal balance down dollar for dollar so that the interest accrual is diminished. Because remember what I said a few seconds ago, the interest is calculated on any open-ended revolving account based on two factors, the balance for the day and the interest rate. So the more you have in depository income and you drop it into your checking account, the longer it stays there, the lower the amount of interest is going to accrue within a 30-day billing cycle. Now, let me just paint one more picture, and then we can open up to what questions come from this. So I want you to imagine, I'm going to use easy round math. I want you to imagine that you have an unpaid principal balance on your mortgage, on your HELOC of $100,000, just for round easy math, and that you bring in $10,000 a month in income from all sources. And just to keep it simple, we're going to say that that $10,000 comes in on day one of month one. Okay. So here's our $100,000 sitting there. My $10,000 is deposited into my checking account. Now my balance is $90,000, right? That $10,000 is not going to be touched. You will not touch that $10,000 for 29 days out of a 30-day billing cycle. And I'm giving you optimal tricks. Okay. This is how you want to use it optimally.
Yeah.
Day one, instead of paying interest on $100,000, you're paying interest on $90,000. And you're going to pay interest only on $90,000 for 29 days out of a 30-day billing cycle. Well, how am I going to make all my bills? And how am I going to eat? And how am I going to pay my cell phone? And what am I going to do? You're going to use a credit card or credit cards of your choice, the ones that provide the best points or whichever you prefer. It doesn't really matter, to pay all those monthly living expenses. Now, we don't want to pay any interest on our credit cards, right? 18, 28%, whatever it is. No, thank you. So now we're going to go to day 30 of that 30-day billing cycle, right? 29 days, that $10,000 has sat in there. Our balance has been 90. Our interest is accrued on that 90. On day 30, the credit card has amassed $9,000 in expenses. You've spent $9,000 for the month on food, gas, utilities, car payments, cell phone, everything goes on that card. Day 30, you go into your checking account where your $10,000 has been sitting, and you write a check to pay off the credit card, $9,000. So for one day of the month, we went from $90,000 in a balance to $99,000, right? $9,000 had to come out of the 10 to pay off the credit card. We had $1,000 left over. Now I want you to fast forward into month 2, day 1. Our starting balance, because that $1,000 left over was our residual income, our discretionary, our savings. It's what was not spent, but I have full access to it should I need it. So day 1, month 2, $99,000 is my outstanding balance. I drop in my $10,000 of income. $89,000 is what I'm going to be paying interest on for 29 days of a 30-day billing cycle. Okay. So this should allow listeners to connect some dots. There are 2 components of compound interest savings. The first being daily. We've got our income dropping in there. It's just sitting. So daily savings, compound interest savings, and then that leftover savings, that residual, that $1,000 is going to be left in there month after month, 24/7 access. That's monthly compound interest savings. So those are the 2 components that make this product profoundly impactful in diminishing that interest accrual over time. Why don't I take a pause?
So with the all-in-one loan, we're really integrating our consumer accounts with our mortgage.
Absolutely right.
Is there a way to automate these payments associated with this?
Yes, I'm glad you asked. So everything that you have become accustomed to today in your checking and savings is going to be exactly the same with the all-in-one. This mortgage is housed by an FDIC insured banking institution. It'll be one of two places, depending on which ends up picking up the rights. It'll be North Point or Merchants Bank. Those are the two that service this loan. Feel free to check them out. When you think about the automation of your checking and savings accounts with your B of A, Chase, Wells Fargo, whomever, credit union, whomever you bank with now, there will be no difference to that experience and this experience. So online bill pay, debit cards, routing numbers, paper checks, should you still use those, mobile apps. If you get a paper check, you take a picture and it uploads to the account. All the same exact automation as you have become used to today will apply with the all-in-one.
And you described how the all-in-one loan is an open-ended loan versus your plain vanilla 30-year fixed amortizing loan, which is close-ended. For those that don't know, what do those terms open-ended and close-ended mean?
So amortized is predetermined over the period of time that you've gotten the mortgage for. So whether it be a 10-year, a 20-year, 25, 15, 30, whatever it is closed-ended. So the interest rate that you secured against the loan amount that you've taken, they have come up with the formula, the calculation that says this is how much interest you're going to pay over this length of time. And the longer the amount of time that you have selected, let's say a 30-year, maybe even a 40-year, those do exist in some cases, the longer the amount of time that closed-ended amortized mortgage is in play, the more interest you're going to pay. Now, it keeps your payment lower for sure, but they're going to make it up in the interest that you'll pay in the long time. Now, the open-ended revolving just means that it is available to pay down and draw up and pay down and draw up. It is not closed.
And then with those conventional mortgages, typically, especially when you originate a new loan for years, most of your payment goes to interest, which would not be the case with the all-in-one loan.
Exactly. Yeah. So anybody that's looked at an amortization table knows the first 10-ish years, we'll just keep using the most common 30-year fixed. First 10 years or so, maybe even a few years past that, 90% of your payment is going to go to the interest. You won't start chunking down any principal until the back end of that mortgage. 180 or complete flip to the all-in-one. Every dollar that goes in there drives the principal down first.
That is huge. Even if you pay a higher interest rate on your all-in-one loan, you can see how you have fewer dollars out of pocket in interest paid, which is what really matters to you.
Exactly right. So think about a 20% interest rate. If you're paying 20% interest on $50,000, then 7% interest on $500,000, you can see how the math will work in your favor, regardless of the number in the interest rate in comparing side to side. And one of the other things that we haven't touched on, and maybe this is a good segue, Keith, it's not just the daily deposits. We have clients that take out a $1 million line of credit, but they have $500,000 sitting idle for whatever it is their business needs and in the e-commerce, it doesn't even matter, but they have this amount of cash that they're simply going to take from this vehicle, a regular checking account over here, and drop it in here. And that interest is saved. That $500,000 that was sitting idle doing nothing over here is now saving interest at an incredible rate. So it's not just the daily and monthly deposits. If you just have idle cash, or you're going to be getting a bonus or a tax refund or whatever it is, those monies that would otherwise just sit in a 1 to 2% maybe interest-bearing checking savings account can now be applied over here, driving down that balance further, dollar for dollar, saving in that interest.
So we are opportunistic investors here. When we see an accumulation of equity in a property or cash in an account, we want to get that moving. With this all-in-one loan, again, which is like a first lien HELOC, I would imagine that when we get plenty of room to borrow more in there, and there's been plenty of pay down, we might want to draw against it again for another purchase and let this thing be flexible, like an accordion, back and forth as you're drawing the balance down and you're extending it out again. So really the way I see the flexibility with the all-in-one loan is that you don't have to go through another mortgage loan origination each time you want to buy a property. You can just draw against this account.
And we're still just scratching the surface in what this thing does. Exactly right. And I've said this twice now, you've become your own bank.
Yeah.
Okay. If you pay it down over a short period of time, let's say that you had $500,000 and you were able to reduce that down to $300,000. There's a $200,000 spread there that at your discretion, you don't have to pre-qualify and pay closing costs again. You don't have to ask permission or get it approved for some reason. Those are your funds, your equity, your dollars to do what you want, when you want, how you want. The other thing too is probably a good place to point this out, safety net. As long as there is a spread between what you owe and the credit limit, whatever that is, if something were to happen that was unfortunate, some unfortunate set of circumstance befell the family, whatever, and no income was coming into the household, zero. What would happen if you didn't have money to make your 30-year fixed mortgage payment? You're going to ruin your credit and go into default. Well, the reverse is true with the all-in-one. If there is a spread between the balance and the limit and you needed to not make any deposits, the only thing that's going to happen in that case is interest is going to accrue on top of that balance. The only time a payment deposit is mandated with the all-in-one is when the balance is about to exceed the limit. That's the only time. Now, I'm not saying that that's the way people are going to use it, but that's the reality of it. So what if let's take this down the rabbit hole for a second. If you couldn't make a deposit, you're not going to go into default, right? You're simply going to add some interest on top of the existing balance. But what if you needed to draw from it for living expenses for a couple of months?
Yeah.
What if you needed, $5,000 a month for 3 months until you got back on your feet? Whatever it is, you have access to do that. There's your safety net. You just simply draw from it. As long as there's a spread between the balance and the limit, those are your funds to do with what you choose.
If one takes out a HELOC, whether that's in an all-in-one loan form or not, something that I've advocated with my listeners for years is that now you do have this line that you can draw against. To your point, Caeli, it's effectively another layer of insurance for that borrower or investor. So if you're interested in keeping down your insurance premium, you can get a HELOC or an all-in-one loan, increase your insurance deductible, which can lower your insurance premium and increase your cash flow.
Good point. I hadn't even thought about that before. That is a new one on me. That is actually brilliant. Yes.
Now, we had a listener quite a while ago, Mark from Granite Bay, California, write in. Mark's a great longtime listener. When he found our show, he wanted to go back and re-listen to all the old episodes, and he listens to several episodes multiple times. And Mark wrote in because he heard you on the show quite a while ago. And Mark says, I've been using the all-in-one loan's amazing mortgage balance deduction, but as a GRE listener, I know I can't be lured in by that alone. I also need to utilize its leverage. I just use my all-in-one loan, Mark continues to say, probably like a lot of others, to buy a duplex for Mid-South home buyers in all cash and then refinance that loan into a Fannie Freddie 30-year from my all-in-one loan simulations. And Caeli has an all-in-one loan simulation on her website that she'll tell you about. But to finish Mark's question, Mark says, I have gathered in these simulations that as long as properties are cash flowing, the best use of the all-in-one seems to be to keep repeating what we did on our first duplex purchase, use the all-in-one loan to buy properties in all cash, and then later refi it into better debt or leverage, and then continue to repeat the process. Is that a valid way to use it? That's Mark's question.
Absolutely, Mark. Well done, sir. And there's a few points here that I want to take a minute and peel back, Keith. So one of the first things that I would say that's really great about that philosophy or that strategy is going to be that on a cash out refinance of the property that was paid cash using the all-in-one, we get to use the appraised value. So under the circumstances, if you paid $100,000 for it and perhaps it valued at 110, 115, 120, whatever it is, then we as the lender are going to refinance on a cash out refinance using that higher appraised value. So you have a little bit more leverage there and potentially get more in that loan to value when you're comparing what you're getting back versus what you put in. The other thing, obviously, is that when you're dealing with a turnkey or a seller, an agent, whatever, everybody knows that when you can come to the table with cash, right, you become the more desirable buyer. There's that obvious piece. And then in terms of that strategy and that simulation, so please, yes, that is absolutely the first thing that I'm going to do with anybody that calls in is I'm going to get on the phone with them, a Teams call, and we're going to do the simulator together. But I encourage everybody to get in there and play around with it. If you're not quite sure what data points it's asking for, let us know or we'll do one together. But that simulator is going to allow you to compare the all-in-one to either an existing mortgage on a primary rental property or a new traditional mortgage. Let's say you're thinking about buying an investment property with a 30-year fixed and you want to compare that to the all-in-one, or maybe you want to refinance one of your existing properties. So you can compare it to existing versus new. And then within that simulation, it will allow you to forecast additional spending that will allow you to say, I want to take out $50,000 in month 22. And it'll reformulate where the simulation of saved interest, payoff time, all of those things will be available to you within that simulator. It's very slick.
And now that you, the investor, have the ability to pay all cash, not only can you close faster, but a lot of times sellers are willing to give you a discount since you can close faster and pay all cash, and then it's up to you down the road to go ahead and refinance that into a conventional product or however else you want to do it. Well, Caeli, what else should we know about the all-in-one loan?
A couple things I would share. First of all, the qualification metric for the all-in-one is going to be a little bit more restrictive than a traditional 30-year fixed mortgage. So be prepared for a little extra brain damage. I know that getting qualified for mortgages is not everybody's favorite activity. I get it. There's a lot that goes on to it. It's not like the good old days where some remember you could fog a mirror and get a mortgage. Sure. But the all-in-one does take it to another level, even beyond what you're used to now. So debt to income ratio, I'll give you the specifics really quickly. So just be prepared. I like to set that expectation. Debt to income ratio caps at 43% on the all-in-one versus 50% that we would have from a traditional Fannie Freddie 30-year fixed. The reserve requirement is calculated based on the line limit. It's dependent on the debt to income ratio. I'll just leave it there. It'll either be 10% or 15% of the line limit. So if the limit was 100 grand, 10,000 or 15,000 is the reserve requirement. And then the minimum credit score requirement, owner occupied is 700, non-owner occupied is 720. So a little bit higher on the bar for qualification for the all-in-one.
Who is this for and who is it not for?
It is for anyone generally that has at least 10% discretionary income at the end of the month. Typically, everybody's circumstances are different. I encourage you to play with the simulator, get on my schedule, let's do it together. But more often than not, we find that 10% left over at the end of the month is generally enough for it to work for the individual. And for those of you that got 2% interest rates during the pandemic, I just want you to know that I'm running the simulator against those loans day in and day out. And I would say, I'll give you a 65% of the time, the all-in-one is beating the you-know-what out of a 2.5% 30-year fixed mortgage.
That is really interesting. Well, there's a lot of opportunity and flexibility with the all-in-one loan. Is there any last thing that we should know about it?
Start doing your due diligence. This does take a minute to unpack. Don't get overwhelmed by all the information. We've talked about some real tangible stuff here, but there's quite a bit that there would be to uncover. So take your time, call us, we'll walk through it step by step.
And get started on that simulator and really see what it can do for you. To make that actionable, Caeli, where should one start?
Head to our website, ridgelendinggroup.com. You can email us info@ridgelendinggroup.com. And obviously, we're always a phone call away at 855-74-RIDGE.
And again, you can find that all-in-one loan simulator where you can plug in some real numbers and see how it can benefit you. A friendly representative from Ridge can help you go ahead and do that there. So there's a lot of excitement about the all-in-one loan, especially for an investor that has a GRE mindset philosophy and thinks about the opportunity of dead equity. But now that we've talked about that, tell us just quickly about some of the other products that you offer in there at Ridge.
So I think one of the real value adds for us is that we're not a one-size-fits-all. We have an extremely diverse menu, as I like to call it, of loan programs. The all-in-one is at the top of a short list of my favorites for some individuals. You got the Fannie Freddies, you've got non-QM, which includes DSCR, debt service coverage ratio, bank statement loans, asset depletion loans. We have ground-up construction for those that are interested in that. We have our short-term bridge loans that I talked briefly about, where if you need fix and flip, fix and hold, potentially you need shorter-term money. Commercial loans for commercial products, commercial loans for residential in a cross-collateralization way, if that is to your advantage. So as you can see, it's quite diverse.
It's been valuable as always, and I definitely learned a few extra things that I did not know about the all-in-one loan myself. Caeli Ridge, it's been great having you back on the show.
Thank you.
Now, a mortgage company, of course, they have overhead and employees that they have to pay and so on. And from talking with Caeli some more, I learned that they don't even make much profit from all-in-one loans. We wanted to discuss it together today for your benefit. However, though, there are some real fees with the all-in-one loan. You pay points of 3 to 4% of the draw in closing costs only. But it's a one-time fee, not every time you draw against it. She also let me know that it does not make your taxes substantially more complicated. If you think that it can help you clear a few minutes, learn more, and get hooked up with that all-in-one loan simulator where they will help you through it, big thanks to Caeli Ridge today. They really make themselves available. You can just call 855-74-RIDGE, or if it's more your style, visit them at ridgelendinggroup.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.